German quarterly growth of 0.8% marginally exceeded forecasts and was double the pace at the end of 2013. France was expected to fail in comparison but had still been forecast to grow by 0.2%. And inventory changes in public spending were the only factors which kept the French economy from contracting, while Germany's performance was driven largely by domestic demand. And the figure for the Eurozone as a whole is due at 0900 GMT and forecast to show growth of 0.4% on the quarter. And France will now need 0.5% growth each quarter to meet a government forecast for subdued 1% growth in 2014, Natixis Asset Management chief economist Philippe Waechter said. And France's public finance plan has been built on the 1% growth forecast. If we don't achieve it, France will not meet its debt and deficit targets for 2014 and 2015, Waechter said. And France is not the only Eurozone member in the doldrums. An Italian gross domestic product contracted unexpectedly by 0.1%, denting a fragile recovery begun at the end of last year when the country finally put an end to its longest recession since World War II. Growth of 0.2% had been forecast. And the Dutch economy shrank sharply, by 1.4% quarter-on-quarter, and Finland fell back into recession as output fell 0.4% from the previous quarter, following a decline of 0.3% in the fourth quarter of 2013. And there were no such problems for Germany. And Berlin expects domestic demand to drive growth of 1.8% this year, and German Finance Minister Wolfgang Schäuble said after the data that everything pointed to a broad economic pickup. And positive impulses came exclusively from within the country, the German Statistics Office said in a statement. By contrast, foreign trade put the brakes on economic growth. And to compound France's problems, a public sector strike has been called by the hardline faux labor union over civil service pay freezes, a reminder of the difficulties of enacting economic reform. And the silver lining is the absence of pressure from the markets, with borrowing costs for many Eurozone countries at record lows. France will auction up to 9.5 billion euros of bonds later. And don't blame the euro, and with recovery from years of economic crisis slow to materialize and prices barely rising, Eurozone inflation was just 0.7% in April. The European Central Bank appears to be preparing to loosen policy at its June meeting. And a number of sources told Reuters that the ECB was working on a package of options, including cuts in all its interest rates and targeted measures aimed at boosting lending to small and mid-sized firms. And we have stressed that we are determined to act swiftly if required and do not rule out further monetary policy easing, ECB Vice President Vitor Constantio said on Thursday. And the ECB has flagged a strong euro as one of its concerns, given the downward pressure it puts on import prices and exports. And French President François Hollande's government wants Eurozone governments to take action on the currency and has called for negotiations to weaken it after EU Parliament elections next week. And the head of France's MEDEF National Employers Association said on Tuesday that Paris should not use its call for a weaker euro as a substitute for much-needed reforms. And other Eurozone countries which have taken strong medicine to improve competitiveness are starting to see the benefits. And Spain reported first-quarter GDP growth of 0.4% 2 weeks ago, giving a year-on-year expansion of 0.6%, the strongest in 3 years. In response, the Spanish government upped its 2014 growth forecast to 1.2% from a previous 0.7%. And in global terms, much depends on China, but there are positive signs elsewhere. And Japan clocked its fastest pace of growth in more than 2 years in the first quarter, raising hopes the economy will have enough momentum to tide over an expected slump following an April 1 sales tax hike. And the United States is expected to bounce back from a weather-ravaged start to the year. And Hollande's government hopes to revive companies' competitiveness with plans to phase out €30 billion, $41 billion, in payroll tax over the next 3 years in exchange for commitments to boost hiring and investment. $1 equals €0.7294, and additional reporting by James Mackenzie in Rome, Madeleine Chambers in Berlin, Jussi Rosendahl in Helsinki and Anthony Deutsch in Amsterdam. Writing by Mike Peacock, editing by Toby Charles.